Welcome to the Microfinance podcast. Listen to inspiring interviews and take a look at tools and products that are used in the field. This podcast is produced by MicroSave, market-led solutions for financial services, and is brought to you by Moving Planet Films.
Just like any other financial institutions, microfinance institutions, or MFIs as they're often called, face a number of types of risk. In my own practice, I find two of those not to be very important as long as one is only doing lending, because liquidity risk and interest rate risk are low. Liquidity risk is usually low because if all I'm doing is lending, I just need to look at my lending cycles and at the projected flows of funds in order to maintain sufficient liquidity to keep the clients happy. The interest rate risk for traditional MFIs is also not very high. The main reason for that is that they are engaged in short-term lending, so if they need to reprice their loans because their refinancing costs have gone up, for instance, they can always do that in terms of just lending to the same clients but at a higher interest rates. This is usually not necessary during the loan cycle itself. So consequently, the pricing risk or the interest rate risk is usually not very high. Two risk categories are very important for microfinance institutions. One is the credit risk itself, and that can play out both at the individual level of an individual loan that may go into default, and then of course also at the portfolio level when we look at the aggregate portfolio. Successful MFIs have managed to deal with the credit risk at the individual level. In fact, I would call that one of the biggest successes of microfinance, to build up collateral substitutes, to look at cash flows, to be in close contact with the clients at all times, to be warned when clients have problems paying back. So one could argue that the big success of microfinance has actually been to work on credit risk, but it's a never-ending battle, and as organizations grow they need to keep looking at this variant. The portfolio risk is something that I feel is becoming more and more important now as microfinance organizations are growing larger and larger portfolios. There are several large MFIs around the world that have portfolios around $100 million. And there one needs to look at risk concentration ratios, at concentration of lending to certain sectors, for instance in agriculture, where there can be a lot of seasonal and also cyclical risk. So those are the kinds of things that would then require an MFI to use more sophisticated portfolio risk management systems in order to stay ahead of the game. Operational risks play a very, very large role in microfinance, and there are many types of operational risks. One very important one has to do with the decentralization of operations in microfinance. So to the extent that loans are granted in branches or sub-agencies, there is certainly a control problem that MFIs need to be very aware of, and for which they certainly want to put the right risk management structures in place. Obviously to have an internal audit function, to use the 4I principle as it is often called, to use credit committees and so forth. Another very important and unfortunately still often not solved issue is the lack of adequate MIS and computer systems. To the extent that MFIs handle portfolios of 10,000 or 100,000 or in some cases more than 1 million clients, they need to be able to monitor the performance of all these outstanding loans. They need to be able to automate internal processes, and all that can only be done with the proper MIS and banking software, and that is an area where many MFIs are still severely lacking.